In every major financial crash of the last century, a strange and uncomfortable truth has always emerged once the dust settles. Some people lose everything, but a small, quietly prepared group walks away with more wealth than they ever imagined. It happened in 1929 when a handful of investors like Jesse Livermore made fortunes as the market collapsed. It happened in 1974 when inflation crushed the middle class but created the largest transfer of assets into the hands of those who had liquidity. It happened in 2008 when private investors who understood leverage scooped up distressed real estate, distressed corporate debt, and oversold equities at pennies on the dollar. Crashes don't only destroy wealth, they also redistribute it. Violently, quickly, and almost always in one direction, toward the people who understand the mechanics of crisis. If you want more deep dive breakdowns like this, make sure to like, comment, and subscribe so you never miss the next upload. The possibility of a 2026 market crash isn't a fantasy or a fear tactic. It's a scenario being discussed quietly across hedge funds, macro research firms, and high-level strategy meetings at major institutions. The conversation doesn't revolve around sensational predictions, but around fundamentals. Corporate debt maturities are clustering in 2025 and 2026. Interest rates remain historically high. Savings are depleted. The federal government is facing its highest peacetime deficit. Commercial real estate values in major U.S. cities continue sliding. Bank exposure remains elevated. And consumer credit has climbed to an unprecedented level, with delinquencies rising quarter after quarter. None of this automatically guarantees a crash, but together, these pressures form the kind of financial environment where an unexpected shock can cascade into a broad market downturn. The majority of people fear downturns because they focus on the destruction. They see red charts, falling portfolios, headlines warning of recession, layoffs, bankruptcies. They feel panic. Panic triggers withdrawal. Withdrawal triggers missed opportunity. But a finance expert sees a different pattern. Crashes create mispricing. Mispricing creates wealth gaps. Wealth gaps, if read correctly, become entry points that never appeared during normal market conditions. The market rarely gives you permission to buy cheap. Crashes force that permission onto everyone, but only a few have the mindset and preparation to take advantage of it. One of the key differences between people who lose wealth in a downturn and those who gain it lies in the understanding of cycles. Markets do not move randomly. They move in rhythms. They contract after periods of excessive expansion. They cool after euphoric periods of cheap borrowing. The years between 2020 and 2021 created one of the most artificially inflated financial environments in history. 0% interest rates, government stimulus, record high liquidity, and unprecedented levels of speculative behavior. Stocks soared. Crypto surged. Real estate exploded. Borrowing boomed. Companies refinanced at nearly zero cost. It was the perfect storm for asset inflation, and now we are living through the opposite of that storm. High rates, tightening liquidity, weakening consumer strength, geopolitical risk, and corporate refinancing pressure. You cannot experience the largest era of cheap money without eventually experiencing the consequences of expensive money. And expensive money does only one thing: it reprices assets downward. This is why many analysts see 2026 not as a guaranteed crash, but as the most mathematically vulnerable year in more than a decade. And if history is any guide, the greatest wealth-building opportunities emerge not when markets are calm, but when fear dominates pricing. The early signs are already appearing. Large institutional funds are increasing their cash allocations, the highest cash positions since 2008. Private equity firms are quietly preparing war chests for distressed acquisitions. Hedge funds are studying credit default charts and tightening their exposure to high-yield corporate debt. Pension funds are adjusting their risk models. Family offices are increasing gold allocations. Even major CEOs are issuing cautious guidance and preparing for liquidity stress. When the people who make billions in financial markets begin preparing for turbulence, it is rarely without good reason. Yet, despite all this, the average person continues living as if the financial landscape is stable. They continue taking on variable rate debt. They continue stretching their budgets. They continue believing the stock market will always recover instantly. They continue treating downturns as rare, apocalyptic events, not cyclical opportunities. And this misunderstanding is exactly why, during every crash, Wealth does not disappear, it simply changes hands. The first step in understanding how a downturn can make someone rich is recognizing that the crash itself is not the wealth creation moment. The crash merely resets the pricing. The opportunities emerge in the aftermath, when assets are mispriced relative to their fundamentals, when fear pushes stocks below intrinsic value, when real estate becomes discounted due to distress rather than true structural weakness, when high-quality companies get sold off simply because the broader market is panicking, when corporate bonds with strong recovery prospects trade at deep discounts. This is the point where financial discipline becomes a competitive advantage. A prepared investor sees undervaluation long before confidence returns to the market. They have liquidity when others have panic. They have strategy when others have fear. They have patience when others seek escape. They do not chase the bottom. They simply recognize when the pricing becomes unrealistic relative to reality. Imagine a scenario where the stock market falls 25% in 2026. At first, the headlines would scream. Retirees would panic. The average investor would sell at a loss. Leveraged traders would liquidate. Companies would announce layoffs. News anchors would talk about recession risk. But beneath all that noise, the fundamentals of many businesses would remain intact. Revenue might decline slightly, but not catastrophically. Cash flow might tighten, but not evaporate. Market share might fluctuate, but not collapse. And yet, their stock prices might be cut in half, not because the business is dying, but because fear is contagious. This is where generational wealth is created, during the moments when the public misinterprets price as truth. Price is not truth. Price is emotion. Fundamentals are truth. And market crashes give you a rare moment where price disconnects from fundamentals so dramatically that the opportunity becomes visible even to those who normally cannot see it. Real estate follows the same logic. In 2008, homes in major U.S. cities dropped 30 to 40%, not because the physical structures lost value, but because the credit system froze and panic ruled the streets. The people who bought into that panic era, those with liquidity, research, and patience, became the landlords and property owners who benefited for more than a decade afterward. The same occurred in the early 1980s when interest rates soared and real estate values fell sharply. Those who understood the cycle bought when no one else wanted to. The result was generational ownership. Markets do not reward the strongest. They reward the most prepared. The 2026 environment is shaping up to resemble historical cycles where preparation mattered far more than timing. Corporate debt maturities will force companies into refinancing at high rates. This will trigger layoffs, reduce earnings, and pull stock prices downward. Consumer spending will weaken as credit card delinquencies rise. Banks will tighten lending. Real estate could see pressure from higher borrowing costs and declining liquidity. Sectors will rotate into decline. Volatility will increase. And as always, the correction will overshoot the rational level before stabilizing. And yet, for a prepared investor, this environment is not a threat. It is an invitation, not to gamble, not to panic, but to wait. Wait for mispricing. Wait for forced selling. Wait for opportunity. Wait for the moment when fear becomes so overwhelming that logic disappears. That is where the seeds of new wealth are planted. And as 2026 approaches, the people positioned for that moment will not be those following headlines. They will be the ones studying the mechanics of the coming downturn right now. When people think about market crashes, they imagine chaos, falling stock prices, panicked investors, emergency headlines, and sudden losses. But what they rarely realize is that crashes unfold in phases, and each phase creates a different kind of opportunity. Wealth is not created at the peak or even at the bottom. It is created when preparation meets dislocation. In the early phase of any downturn, markets begin repricing risk. Investors pull capital from sectors that look exposed. Some companies begin warning about tightening margins, falling demand, or refinancing pressure. These early signals cause prices to fall unevenly. Strong companies get punished alongside weak ones. Good businesses get sold off because the broader market is reacting emotionally. And this is where the first advantage emerges: the ability to distinguish between temporary fear and structural weakness. The average investor responds to falling prices with dread. They see red charts and imagine permanent decline. But a finance expert looks for dislocations between fundamentals and market behavior. The expert studies cash flow, debt ratios, long-term assets, business models, and competitive advantages. They learn to identify which companies are facing temporary pressure and which are structurally compromised. Because in every crash, the majority of selling is indiscriminate. Investors do not sell because they carefully calculated intrinsic values. They sell because they are afraid. They sell because liquidity dries up. They sell because margin calls hit. They sell because the herd is moving. And that mass selling creates opportunity long before the bottom is reached. As economic weakness deepens, the second phase of opportunity appears: forced selling. This is when the real wealth transfer begins. Forced selling happens when investors or institutions are compelled to liquidate assets even if they don't want to. It can be triggered by leverage, debt maturities, redemptions, margin calls, or liquidity shortages. During the 2008 crisis, hedge funds and financial institutions dumped high-quality assets not because they believed those assets were worthless, but because they needed cash immediately. Mortgage-backed securities that were fundamentally sound traded at deep discounts simply because liquidity evaporated. Corporate bonds from profitable companies traded at distressed prices because portfolios needed rebalancing. Even blue-chip stocks temporarily collapsed because money managers had to meet redemption requests from panicked clients. Crashes expose the difference between investors who need liquidity and those who possess liquidity. A similar dynamic is expected in 2026. With corporate refinancing costs rising and banks tightening credit, many companies will be forced to preserve liquidity by selling assets, cutting investments, or reducing financial commitments. Private equity firms facing mounting debt obligations may be forced to sell divisions or entire companies at lower valuations. Investors who bought into speculative assets during the cheap money era will face losses and liquidate positions to cover debt. Any sector heavily exposed to refinancing pressure, real estate, consumer discretionary, leveraged services, may see accelerated selling regardless of long-term value. This is the moment when a prepared investor can accumulate assets at valuations not seen in years. The third phase occurs when fear peaks. This is the point where markets often overshoot to the downside. It usually happens after a major event, an unexpected bankruptcy, a sudden liquidity freeze, a geopolitical shock, or a surprising economic report. During these moments, selling becomes emotional rather than rational. The market temporarily disconnects from reality. Prices fall faster than fundamentals deteriorate. Investors capitulate. Long-term value is ignored. This overshooting phenomenon is one of the most predictable patterns in financial history. It happened in 1987, 2000, 2008, 2020, and dozens of times before. And it's likely to happen again in 2026 if stress accumulates the way current data suggests. To a prepared investor, this phase is the equivalent of an open door. But it requires two things: liquidity and discipline. Liquidity allows you to buy when others cannot. Discipline prevents you from being swept up in the panic. The people who become wealthy during crashes do not rely on perfect timing. They rely on recognizing when market behavior becomes irrationally pessimistic about assets whose long-term potential remains intact. They position themselves not for immediate profit, but for multi-year appreciation once conditions stabilize. Wealth creation during downturns is not a matter of luck. It is a matter of anticipation. But anticipation alone is not enough. You need strategy. One of the core strategies used by sophisticated investors during downturns is staggered accumulation. Instead of trying to buy at the exact bottom, they accumulate positions gradually as valuations become attractive. They do not care if the market drops another 5% after they buy. They focus on value, not noise. Over several months, they build positions that will later become the foundation of their recovery phase portfolio. By the time the market rebounds, they are already positioned. Another strategy involves identifying sectors that historically lead recoveries. After the dot-com crash, infrastructure, value stocks, and early-stage tech recovered first. After 2008, real estate, financials, and industrials led the rebound. After the COVID shock in 2020, technology and consumer discretionary surged. During each crisis, the sectors hit hardest often produce the highest returns once conditions normalize. The key is distinguishing between sectors temporarily damaged and those permanently impaired. For example, commercial real estate with long-term structural issues may not recover quickly, while manufacturing companies with temporary margin pressure may rebound strongly. A prepared investor studies these differences before the crash, not during it. But one of the most powerful strategies available to investors during downturns involves fixed income markets, specifically corporate bonds and distressed debt. When companies face refinancing pressure, their bonds often trade at steep discounts. Some of these companies will fail, but many will survive. Buying the debt of a company that eventually recovers can produce returns far higher than equities alone. Investors who bought discounted corporate bonds during the 2008 crisis made extraordinary returns as companies stabilized and bond prices normalized. A similar opportunity may appear in 2026 if credit markets tighten and companies with strong fundamentals are temporarily priced as distressed because of refinancing pressure. Real estate follows the same pattern. A downturn often forces sellers to accept lower prices due to liquidity issues, not property fundamentals. Investors with cash in 2010 acquired properties at deep discounts and saw massive returns over the next decade. A 2026 downturn could create similar opportunities in housing markets, multifamily units, or distressed commercial assets. But timing is crucial. Real estate markets move slower than stocks, giving prepared investors more time to analyze and act. Cryptocurrency markets also behave cyclically, with crashes producing multi-year accumulation zones. While speculative assets carry more risk, the same principle applies. Crashes reset valuations and create entry points that do not exist during bull markets. The key difference is volatility. Crypto cycles are more extreme than equity cycles. A prepared investor treats it as a satellite allocation, not a core portfolio element. Throughout all of this, the most important skill is recognizing when panic becomes excessive. Financial history shows that markets recover not because sentiment improves, but because panic eventually exhausts itself. Sellers eventually run out of assets to liquidate. Forced selling slows. Valuations normalize. Liquidity slowly returns. And as soon as the slightest positive signal emerges, strong earnings, lower inflation, improved credit conditions, investors who waited on the sidelines rush back in. This rush fuels the early stages of recovery, driving prices sharply higher. Those who bought during the downturn benefit disproportionately. The 2026 environment adds one more variable: generational pessimism. Young investors who entered markets during the 2021 to 2022 volatility carry an emotional memory of losses. They are more likely to panic sell and less likely to buy during downturns. That hesitation will create even more mispricing. In contrast, experienced investors will seize opportunities. They will understand that fear is temporary, but value is permanent. They know that markets do not reward people who react emotionally. They reward people who react strategically. The final ingredient in wealth creation during downturns is patience. Even the best-positioned portfolios do not explode in value overnight. Recoveries take time. They move unevenly. Some sectors recover quickly, others crawl. But over months and years, the opportunities taken during the crash compound. Dividends resume. Buybacks restart. Earnings stabilize. Confidence returns. And the assets accumulated during the darkest moments begin to reflect their true long-term value. What looks like luck to the outside world is nothing more than preparation meeting dislocation. And as 2026 approaches, the window for preparation is still open. As the possibility of a 2026 downturn grows more realistic, the most overlooked concept is that crashes don't simply destroy wealth, they reshuffle it. The market does not vaporize money, it transfers it. From the over-leveraged to the liquid, from the panicked to the patient, from the uninformed to the prepared. Every crisis in history has followed this pattern, and the next one will be no different. But the people who benefit are almost always the ones who understand what to do during the quiet moments before panic unfolds. They don't wait for the headlines to confirm the crisis. They anticipate the behaviors that make a crisis profitable. A crash begins in sentiment long before it appears in charts. Months before markets break, institutional investors adjust exposure. Hedge funds rotate into defensive sectors. Insiders sell stock. Companies withdraw aggressive guidance. Analysts quietly lower earnings estimates. This subtle shift forms the early landscape of opportunity, not because prices collapse instantly, but because the psychology of the market changes. The prepared investor observes the shift and begins mapping where stress is building. They pay attention to liquidity ratios, leverage levels, refinancing schedules, and sector vulnerabilities. They understand that the seeds of opportunity appear when institutional confidence weakens, even if the public remains unaware. As the downturn progresses, another important dynamic emerges: the separation between noise and signal. Headlines amplify fear. Social media spreads exaggerated narratives. Retail investors react emotionally. But beneath all the noise, real financial signals appear. Signals about which companies hold strong balance sheets, which sectors maintain stable demand, which assets are being mispriced due to panic rather than fundamentals. This separation is where wealth creation begins. The prepared investor does not chase the noise. They examine cash flow statements. They evaluate debt maturities. They assess management credibility. They look for the moments when price ceases to reflect reality. Because markets are not efficient in times of distress, they are erratic. The heart of opportunity in a downturn comes from one simple truth: markets overshoot. They always overshoot. They overshoot on the way up during euphoric optimism and overshoot on the way down during emotional panic. When prices fall far below reasonable valuation, the investor with patience gains an edge. They are not trying to predict the exact bottom. They are focusing on buying assets during mispricing. And mispricing is most powerful when the market is driven by fear rather than math. During the late stages of a crash, liquidity becomes the rarest asset in the market. People desperately seek cash. Funds face redemptions. Leveraged traders unwind positions. Companies draw down credit lines. Banks tighten lending. This rapid tightening of liquidity forces selling even among strong holders. Some sell because they must. Others sell because they panic. But forced selling is the moment when extraordinary deals appear. A healthy company's stock can fall 40% simply because institutions need cash immediately. A strong real estate asset can be sold at a discount because the owner cannot refinance. A profitable company's bonds can trade at distressed prices because credit markets freeze. These are not theoretical scenarios. They happened in 2008, 2000, 1974, 1982, and 2020. They will happen again if the 2026 environment unfolds the same way. For the prepared investor, these forced selling moments are the opportunity of a lifetime. They allow the acquisition of valuable assets at prices that will not exist again once liquidity returns. But this requires emotional discipline. While others panic about falling prices, the prepared investor focuses on long-term fundamentals. They do not assume every decline signals disaster. They understand that the market always overreacts. One of the most strategic wealth-building opportunities during downturns involves buying high-quality companies with strong balance sheets at massive discounts. Historically, companies with durable business models, recurring revenue, and conservative leverage recover faster and stronger after crashes. When their valuations fall due to broader market panic, the long-term investor who buys them benefits not only from price recovery, but from dividend reinvestment, earnings growth, and the compounding effect that follows recovery phases. Many of the world's wealthiest investors built their fortunes by buying great companies during bad times. Another powerful opportunity appears in distressed debt markets. When fear peaks, bonds of perfectly healthy companies can trade at steep discounts simply because liquidity vanishes. Investors who understand corporate credit can earn equity-like returns with lower risk by buying these discounted bonds and holding them until recovery. The 2008 crisis created extraordinary returns for those who bought corporate debt that later recovered. The same happened in the early 1990s and again in 2020. If the 2026 refinancing wall forces companies into temporary distress, the prepared investor can capitalize by buying the debt of survivors before the market realizes they will be fine. Real estate also offers opportunities during downturns. Financial pressure forces owners to sell, even when properties are structurally sound. Investors with patient capital can acquire undervalued assets and benefit from the eventual normalization of financing conditions. In the last major downturns, those who bought during moments of maximum pessimism generated the highest long-term returns, not by speculation, but by disciplined accumulation. Cryptocurrency markets may also present opportunities, though with higher volatility. Crashes in crypto markets often create multi-year accumulation phases. Investors who buy during these periods, not at euphoric highs, benefit greatly when sentiment shifts. However, this requires strict risk control and an understanding that crypto behaves more like a speculative asset than a traditional investment. But the biggest opportunity in any crash is psychological. Crashes change behavior. They reset sentiment. They reset valuations. They reset expectations. Investors who learn from the cycle gain more than just profits. They gain the experience needed to navigate future downturns with confidence. The greatest financial advantage is learning to remain rational when others lose clarity. If a 2026 downturn materializes, the prepared investor will already have a plan. They will know which sectors they want to target. They will know which companies have strong fundamentals. They will know the debt profiles of firms they want to buy. They will know which assets historically recover fastest. They will know how to build positions gradually. They will know how to control fear. And most importantly, they will know the difference between price declines that signal danger and price declines that signal opportunity. The people who become wealthy during crashes do not guess. They prepare. They do not panic. They observe. They do not chase trends. They study cycles. They do not hold illusions about perfect timing. They focus on disciplined entry. They do not rely on emotion. They rely on probability. Once the crash bottoms and recovery begins, the market shifts quickly. Even a mild positive signal, lower inflation, an interest rate cut, stronger earnings, can ignite a wave of buying. Investors who hesitated rush back in. Funds begin allocating capital again. Spreads tighten. Credit stabilizes. And as confidence quietly returns, prices rise far faster than the average person expects. This is where the prepared investor's patience pays off. They gain not only from the rebound, but from the compounding that follows. History has shown repeatedly that the people who transform crashes into long-term wealth are the ones who enter the crisis with a roadmap and emerge with conviction. They understand that markets are not built to reward anxiety. They reward preparation, discipline, liquidity, and rational thinking. When the next downturn arrives, whether in 2026 or another year, the people who benefit will be those who see beyond the fear and recognize the mechanics of opportunity hidden inside volatility. A crash is never pleasant, but it is always clarifying. It exposes weaknesses, resets valuations, punishes excess, and reveals what was fragile all along. And for the investor who understands cycles, who studies history, who analyzes fundamentals, and who prepares before the storm, a crash can become the most powerful wealth-building event of their lifetime. Because in the end, markets don't just crash, they reset. And those resets create the moments where the next generation of wealth quietly begins.